Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, US inflation falls to 2.4% according to the Fed's preferred measure. As well as that, Vladimir Putin warns of a wider conflict over Ukraine. We've got lots to talk about on the charts also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure you subscribe. The first article to talk about is on the topic of US inflation. Now, yesterday's data showed that US inflation had fallen to 2.4% year on year in January, with this data furthering expectations of rate cuts later this year. Now, rate cuts, inflation. That's really what we've been talking about a lot recently, and is really the key thing that we're always going to be talking about because it relates to the markets the most. Out of all these kind of topics that we might see in the news, I think inflation and interest rates are the most important, seen as we're mainly currency and commodity traders over here. But ultimately, the topic of US inflation is very, very interesting to kind of talk about once again. Ultimately, because we've actually seen quite conflicting messages recently in regards to inflation around the world, but especially within these more advanced economies such as the UK, Eurozone, and the US. With the US even, recently having certain pieces of data and certain kind of rhetoric from certain Fed officials, which has actually led traders to believe that there was going to be less rate cuts than they were previously expecting. I can't pin the exact piece of data that did come out recently, but ultimately, recent data has actually led certain investors to walk back their expectations of 6 to 8 rate cuts this year to that 4 rate cut figure that is what we've heard already from Fed officials. So to put more context into this, basically last year when we started to hear the Fed changing its rhetoric into something that was far more dovish, what we actually did start to see was traders kind of selling off on the dollar basically, and buying up on US equities. And this is because they started to expect rate cuts earlier than expected before, and this is because now the Fed wasn't talking about raising rates further, but rather talking about when to cut them next. That said, we actually didn't hear much from the Fed until the new year around, when rate cuts were going to start or how many rate cuts this year there were actually going to be. And when we first did hear from the Fed around how many rate cuts there were going to be, it was around the 4 rate cuts this year figure, which was lower than the figure that was kind of expected by traders and is kind of still expected by traders to this day, with most traders I think expecting around 6 to 8 rate cuts this year, especially before the most recent US data that came out before this. Investors really were kind of very optimistic about the Fed being able to cut rates so early, despite inflation being persistent in certain areas of the economy. But as I just spoke about, the most recent data before this did kind of present a more pessimistic image, one that kind of reinforced what the Fed has been saying all along about waiting longer to see whether inflation does persist within the economy. And only once inflation is at that 2% figure can we then start talking about cutting rates. And so as a result, we did see that kind of change up take place, with also investors kind of moving away from those March rate cuts expectations to more kind of May, June expectations. So that's what's kind of happened recently and before this piece of data, which makes this piece of data so much more important because now we're actually seeing inflation fall below what economists were expecting, so doing better basically, coming in at 2.4%, so close, of course, to the the target figure of 2%. Whilst that is the nominal figure, the headline figure, that is not the kind of the core figure, which kind of the Fed follows more. This is still a very key piece of data, which obviously will be playing on the minds of economists, the Fed, and especially investors. As this figure is very close to that 2%, as I've just said, and as a result, will create this more optimistic view within the economy, where rate cuts will be expected sooner. As a result, people will start expecting, cheaper loans for businesses. As a result, US equities start to rise again, or just continue to rise as they've been rising a lot recently, as we'll get into on the charts in a bit. And also we'll see, certain FX pairs in relation to the dollar, or even just the dollar on its own, starting to sell off as investors do move their money out the dollar, maybe put it in gold or other kind of safe haven assets and commodities to protect themselves from these lower interest rates which could be coming. And so that's the current situation that we're in at the moment, with the US inflation rate figure and the US dollar and US economy as a whole. Now, this data came in line with economists' expectations and presents a fall from the 2.6% figure we received in December, which at the time led many to revise their rate cut expectations. As for the month-on-month figure, inflation was at 0.3% last month. As a result of the new data, the S&P 500, of course, rose slowly, whilst the 2-year yield did fall off by 0.01%. The inflation figures presented the lowest level for nearly 3 years, and the core rate came in line with expectations of 2.8%. And we know that 2.8% figure, that core inflation rate figure, is far more sticky, doesn't really want to move, and so we'll often see that figure stay around the same levels that we've maybe seen a few months before, whereas we do see this kind of nominal figure move a lot and is far more volatile, but that core inflation rate figure, we always have to remember, is the key one that the Fed follows. So maybe we'll hear this really amazing or surprising nominal figure, but ultimately when we're actually trying to factor in what the Fed's thinking, the core inflation rate figure is the one to look out for and keep your eyes on. Now, a separate inflation rate figure from the Bureau of Economic Analysis presents inflation still in the 3% territory, sitting at 3.1%. The all-time peak of the inflation rate figures in recent years, of course, has been in the aftermath of Russia's invasion into Ukraine, when inflation levels skyrocketed to 7.1%. Recent Fed rhetoric has shown, however, that the Fed is hesitant to move interest rates lower until inflation is on a clear trajectory to the downside and has returned to near the 2% target, which is why having a figure of 2.4% is so amazing and kind of optimistic for certain traders. So keep your eyes on things in relation to the US dollar and US economy as a whole, of course, and most importantly, probably the US inflation rate figure and US interest rates as a result. That's all to talk about on the Financial Times and on the first article. Oh well, that's not all to talk about on the Financial Times. The next article to talk about is on the regards to geopolitics and world tensions, with Vladimir Putin warning of a wider conflict over Ukraine. And this really comes back down to why we always talk about geopolitics. I reinforce it all the time, but I think it's so important because it's a very looked over kind of matter within trading and fundamental analysis, is looking at politics, looking at geopolitics, looking at world tensions, this kind of thing, to kind of gauge where the future for the planet, for different economies, is less so on the more quantitative front and the pure data side, and more so just looking at what's happening on the ground in these nations and how's that going to affect different economies. Just look at the situation with Ukraine. The invasion of Ukraine massively changed the way we were seeing oil exports, the way we were seeing grain exports. So these two commodities instantly had their markets completely changed by this invasion, let alone gold or something, which is a safe haven asset, which of course, as a result of geopolitics, not geopolitics, as a result of world tensions heightening, we saw gold skyrocket. And we've seen changes in the US dollar as a result of this, and the ruble, and all these kind of different currencies, which of course interlock with one another in different ways, which is why this is so important. And of course, any rhetoric in regards to World War III or wider conflicts not only weighs on the maybe the assets or commodities which are nearby such nations, such as oil in the Middle East or grain in Ukraine, but also it's so important because obviously it's going to affect world tensions, which obviously affects safe haven assets as well as just wider equities. I mean, if we're looking at the US equities market, should a wider conflict take place, whilst it may seem so far away, should a wider conflict take place, we would in a day see US equities fall to the downside most likely, just as a result of those businesses suddenly being in a position where they don't know what the future is, they don't know how to kind of proceed further. They're not going to exactly be thinking about business expansion if they're in a wartime period. So all these kind of different things affect markets, which is why this is so important. Now, in a recent now Putin has now said that continued Western support for Ukraine could trigger a world war. This comes as his clearest threat to use nuclear weapons yet since the Russian invasion into Ukraine started. In a recent speech, Putin made clear that the claims that Russia wanted to attack Europe was complete nonsense. The heart-dropping statement came, however, after when he spoke about increases in Western support for Ukraine, which he said risked a conflict with nuclear weapons. And of course, since the start of the invasion of Ukraine, we have seen NATO partners and European allies really increase the kind of the assets that they're sending, the weapons assets, the lethal assets, which they are sending to Ukraine in its fight against Russia. Basically, we started off kind of just thinking about just basic small arms and different weaponry like that. And this kind of escalated to then, sending tanks and now fighter jets. So, this is a serious escalation. Every kind of new package that is sent, obviously, is a kind of small escalation in itself. And what Putin's talking about here is continuing that, furthering that, increasing, the severity of these weapons being sent. We're more and more likely to see, a wider conflict arise. And most recently, of course, we did have Emmanuel Macron talking about troops, which is what we're about to talk about. Now, this obviously follows recent comments made by Emmanuel Macron around sending Western troops to Ukraine. Putin made clear his belief that any army that chooses to intervene will have a tragic end. The EU has since responded to the comments, saying the threat was unacceptable by Russia. This all comes in the lead up, of course, to the next Russian presidential election, where Putin has put himself forward to be re-elected. In the lead up, however, it is clear there are no real challenges to Putin's rule. In a recent speech, he also made clear that he was interested in increasing Russia's ability to strike Western nations whilst bolstering his country's nuclear forces. Putin also denied the claims of a Russian nuclear weapon in space, which of course has been a recent point of world tensions. That's all to talk about in the articles, though. We've talked about a lot of stuff over quite a bit of time, so it's time to move on from that. Next article, no, not an article, sorry, I can't follow myself at this point. Next thing to talk about, of course, is the charts, where we do have quite a bit happening. Certainly quite a bit happening, but beginning on the US equities, we're actually not seeing much happen, despite that key inflation rate figure that we saw today. Now, whilst usually one would expect a big inflation rate figure like that, it's going to move markets. Those inflation rate figures came in line with expectations, and we always have to look at markets and data in the sense of what forecasts were and what the actual figure was. So even though we did see that decline in inflation, which might cause many to kind of see push for a rise in US equities, maybe cause people to buy up US equities, ultimately it's the difference in the forecast and the actual figure. And there were no differences in both the core inflation rate figure and just the nominal inflation rate figure. And that's why really I don't think we've seen much moves, especially on the US 30. Now, An important note to obviously make when we're talking about US equities and interest rates and US inflation is, of course, that these larger companies, which are within these indices and indexes, are going to be less affected by interest rate changes. And this is just largely because they have larger cash reserves, they have more assets to kind of leverage, and as a result, it's less of an issue for them. That's not to say that those inflation figures aren't going to massively move markets, but when we're looking at different assets and what's going to be moved the most, it's never going to be the US 30 or the US 500, which is being moved the most by US interest rates. It's going to be those smaller company indexes, which are going to be pushed around in the markets with great volatility during times of new interest rates and new inflation figures. So that's something that's important to note. And currently we're sitting around that 50%. Well, we actually have reacted to that 50% kind of, and we're now kind of consolidating on the US 30. So keep your eyes on the US 30 nonetheless. Next to talk about though is the dollar, which is kind of on the rise almost at the moment. We're kind of seeing this gain in bullish momentum with price now moving to the upside. That said, we're not really seeing that much momentum to the upside, and with that US inflation rate figure today, one might expect a sell-off on the dollar, but we're not really seeing that, and that once again is because it's coming in line with the forecast, and it's not that significant of a change from the figure that we did receive before. And ultimately, we've got a lot of other things which are moving the dollar at the same time. Think world tensions, as we've just spoken about. Think just global politics and even domestic politics within the US, which is all affecting the dollar. Next to talk about though is Euro USD. So obviously still on the topic of the dollar, which has once again reacted to this key liquidity zone. We've kind of spoken about a few times now, since prices kind of been on the upswing recently, this kind of upward retracement. I think this has largely been triggered, of course, by this kind of change in perceptions by US investors recently, where kind of ending off last year, or at least coming up to the end of last year, October-November period, we did have that switch in the Fed's rhetoric. Investors were kind of seeing a more bullish image for US equities, and we were kind of expecting more rate cuts from the Fed, but obviously more recently, within the past few weeks, maybe month or two, we actually have started to see some signs kind of emerge from the Fed, which present maybe there aren't going to be as many rate cuts as we previously expected. Maybe inflation is more persistent than we previously expected. And this is kind of all being reinforced by different economic kind of figures. And that's why we really are kind of seeing this short retracement and upswing on the Euro USD. But that said, after today's inflation rate figure, we are now seeing a sell-off take place. And that's actually against what one would expect maybe, but actually would it be? No, but ultimately price has reacted to that liquidity level once again, and so definitely we could be looking at continuation to the downside, as this could be now presenting this kind of reversal pattern that it's not a head and shoulders pattern, but certainly a pattern which is kind of presenting new lower highs, which obviously always presents this kind of more downward momentum. So keep your eyes on the Euro USD. Next to talk about quickly is pound yen, where we are now seeing a sell-off take place from those highs where price was stagnating. As I spoke about recently though, at those highs that we were seeing pound yen reach, we were looking at pound yen touching its Fibonacci extension level, which price had been reacting with greatly, and we were seeing on the 1 hour especially a head and shoulders pattern form with its baseline then two shoulders, and as a result this of course is a very bearish signal. And just a day ago, just yesterday, we did finally see price break through that baseline in the Tokyo session and rush to the downside, which is in line with what we might expect from a head and shoulders pattern. What is interesting to see now though is that price is reacting to that 61.80, so maybe we do find some bullish momentum from that area. So definitely take that into account and take note of that. as you know, that 6180 also does line up with some key liquidity zones as well. You know, some great deal of some great deal of liquidity and support in there. So you know, keep your eyes on that as well. But price has broken through, you know, that 38.20 and that 50%. So maybe factor that in as well. Next to talk about is Bitcoin, which obviously has seen a great deal of volatility recently, shooting to the upside and reaching that $64,000 a Bitcoin level. But since then, we have seen now price kind of experience a sell-off, as we were expecting, since I did note that they are on the RSI. Bitcoin was at that 90 point level, and since then we have seen a sell-off from the $64,000 mark, and now prices around the $61,000 mark. It's just really hard to kind of judge Bitcoin at the moment with so much volatility in the air. Obviously, we could now retrace down to these Fibonacci levels, but I think, you know, there's so many factors at play at the moment, so much noise, it could be very hard to gauge kind of an idea. So you know, keep your eyes on Bitcoin though, nonetheless. Next to talk about is gold. Gold's in a very interesting position, currently sitting around this liquidity zone and previous resistance level, but we've kind of broken above it now, so maybe we can retest that and move higher. Lastly to talk about on the charts though is oil, which once again is just continuing to range. Not much to say on oil, but obviously look to the Middle East and the world tensions there to kind of gauge a better understanding of oil. That's all to talk about on the chart. So lastly to talk about, of course, is the economic calendar, where I would say we are getting the most amount of data today out of all the weeks maybe. So firstly, we are getting the Chinese manufacturing figure, followed by the Japanese consumer confidence figure, and then the Swiss retail sales figure, followed by that Eurozone, British, German, French, Swiss, and Spanish manufacturing figures. So lots of manufacturing figures, especially in Europe today, as well as that we're getting the Eurozone and Italian unemployment rate figure, followed by the Eurozone inflation rate figure. So a very important inflation rate figure to note, of course, followed by that the Italian inflation rate figure and GDP growth rate figure. So lots of Eurozone and European data today that's very important to listen out for, followed by that the US and Canadian manufacturing figure as well, followed by US consumer confidence figure, and finally some numerous Fed official speeches to end off the week and, you know, gain a better understanding of the Fed's rhetoric and outlook. That's all to talk about though on the economic calendar. We've covered lots in the articles, lots on the charts, and lots on the economic calendar. Once again, that's all from us at Wildwood Capital. Hope you have a great trading day and a great weekend. Make sure to enjoy it, you know, take some time away from the charts and relax. But that's all from us once again at Wildwood Capital. Have a great one. See you later. Bye.